What if I told you that a few simple changes to your daily routine could significantly improve your financial health? Today, we are talking about money habits, those little actions that can make a big difference in your bank account. From automating your savings to making smarter spending choices, these tips are designed to help you keep and grow your hard-earned money. Let's start with an often overlooked habit, and that is automating your savings. Only 20% of Americans save automatically each month, but those who do are far more likely to build a solid financial cushion. Automation works because it removes the need for decision making and also avoids procrastination. Set up direct deposits into a high-yield savings account on the day you receive your paycheck. Start small if needed. 5% of your income can make a huge difference over time. The key is being consistent with your savings. Once you have automated your savings, you are already ahead of the curve. But saving is just one piece of the puzzle. So let's move on and discuss budgeting, which is often seen as restrictive, but think of it as a plan for your money. Around 60% of people don't use a budget at all, and that is a huge missed opportunity. Because every successful financial plan starts with a budget. It helps you understand where your money goes, allowing you to make informed decisions about your spending. Following a budget is not about depriving yourself. It is about making sure that your money is working for you. Start by tracking your expenses for a month, categorizing them into needs like rent, groceries and utilities, and wants like dining out and entertainment. Make sure that you are not spending more than what you earn. Otherwise, you can quickly get into a negative debt spiral. You will have to review your budget regularly and adjust it as needed, but stick to the spending limits you have originally set yourself. You can use the financial planner I have put together. This will help you to track your budget easier. With your budget in place, you have set the foundation for smart money management. But managing money isn't just about cutting back. It is also about making your money grow. This is where investing comes in. To invest effectively, you must first understand the difference between assets and liabilities. Assets like real estate, stocks and skills generate income or increase in value over time, while liabilities like car loans and credit card debt cost you money. The key to building wealth is to acquire assets that generate income and increase in value over time, while reducing or getting rid of liabilities entirely. For example, investing in a rental property can provide both value appreciation and passive income as well, but credit card debt only accrues interest that you will have to pay off. This is why understanding the balance between assets and liabilities is essential. But it is also important to address the fear of risk, a common concern which often holds people back from investing at all. People oftentimes fear the risk associated with investing, particularly investing in the stock market, because it often feels like gambling to those who are risk-averse. The volatility of markets, economic uncertainties, and the fear of losing hard-earned money can be overwhelming. However, this fear can lead to the mistake of avoiding investments altogether. This can be damaging in the long run, because inflation is eroding the value of money sitting in your account. The key is to understand that all investments carry some level of risk, but not all risks are created equal. There are two important factors which can help you to reduce your risk. One is diversification. This is because diversifying your portfolio and spreading your investments across different asset classes, like bonds, stocks, and real estate, you can mitigate some of the risk. The other is having a long-term perspective. This will allow you to ride out short-term market fluctuations. And at the end of the day, markets tend to go up in the long run. Start small and increase your investment as you become more comfortable. For younger investors, a more aggressive portfolio with a higher proportion of stocks might be appropriate, as they have more time to recover should there be a dip in the market. But this also makes it more likely that they will earn a higher return on the investments over the long run. Remember, taking calculated risk is necessary for financial growth. Investing is not about avoiding risk, but about managing it effectively. By recognizing that not all risks are the same, and that diversification and a long-term perspective can mitigate many uncertainties, you empower yourself to make smarter financial decisions. But understanding risk is not just about avoiding potential losses. It is about positioning yourself to seize opportunities which have significant upside potential. Once you have built the confidence to manage risk effectively, the next step is to put your money to work and start planning for the future. One of the most powerful ways to secure your financial future is to start investing as early as possible. The earlier you start, the more time your money has to grow with the help of compounding. For example, if you invest $400 a month starting when you are 25 years old, and you keep investing until you are 65, assuming a 7% annual return, at the end you could have around $1 million. But if you wait until the age of 35 to start investing, you would have to contribute more than twice as much each and every month to reach the same goal. So instead of the original $400, you would need to save more than $850 each month to reach the $1 million mark. You can clearly see that time is one of your most valuable assets in investing. And while retirement may feel like a distant goal, the decisions you make today can shape the quality of life you enjoy later. So let's have a quick look how much money people have in their retirement accounts. The balance of retirement accounts varies significantly by age. For example, people under 25 had the lowest median retirement balance of $2,816, which is logical as they are at the beginning of their careers. Those aged between 25 and 34 had a balance of close to $15,000, while people 65 and older had the highest retirement savings with a median of $88,500. These figures suggest that many may not be on track for a comfortable retirement at all, which also highlights the need to start planning and investing as early as possible. Consider how much you will need to maintain your lifestyle in retirement. You can use retirement calculators to estimate how much you should save and how your investments might grow over time. Retirement planning is essential, but so is having a safety net for the unexpected in the form of an emergency fund. So let's discuss that next. A survey found that 56% of people can't pay an unexpected $1,000 expense from their savings. This is where an emergency fund comes in. An emergency fund acts as a financial buffer, preventing debt when unexpected expenses arise. It is peace of mind knowing that you can handle a car repair, a medical bill, or even job loss without falling behind. You should target to save around 6 months worth of living expenses. But this number highly depends on your personal situation. For example, your industry, the role within the company, and so on. To make it easier, set up automatic transfers on the day you receive your paycheck. This will help you to stay consistent, as this kind of automation eliminates the possibility of procrastination and finding all kinds of excuses. For example, you can save $100 a month, and with time, you will get to your target number. Just get in the habit to put aside some money each month. Keep this money in a high-yield savings account where it is easily accessible, but where it is separate from your daily spending. Once you have your emergency fund in place, you have safeguarded your finances against the unexpected. Effectively managing debt is a crucial step towards financial freedom, as it allows you to regain control of your finances and focus on building wealth rather than paying interest. People owe on average over $6,000 on their credit cards, and reducing this debt is a critical step towards financial freedom. People who stick to a debt repayment plan are 31% more likely to eliminate their debt entirely. Two popular methods to pay down debt are the avalanche method and the snowball method. If you would like to follow the avalanche method, then start by listing all your debts and their respective interest rates. Prioritize paying off the highest interest debt first while making minimum payments on the others. Let's say that you have two credit cards. One of the credit cards has a $3,000 balance and comes with a 15% interest rate, while the other card has a $2,000 balance and has a 10% interest rate. Using the avalanche method, you will pay as much as you can towards credit card A, as that has the higher interest rate, while making minimum payments on the other card. The avalanche method is best if you want to save the most on interest and can stay disciplined over time. The snowball method, emphasizing paying off the smallest balance first to build momentum and stay motivated, regardless of the interest rate. Using the same example, you would focus on paying as much as you can towards the credit card with a $2,000 balance and 10% interest, as that is the smaller amount of the two, and then make minimum payments on the other card. This method is ideal if you are the kind of person who needs quick psychological wins early on to stay motivated in the long run. Also consider consolidating your debt with a lower interest loan if it makes sense for your situation. By being disciplined and strategic, you can get out of bad debt and stay debt-free. Financial freedom isn't just a dream. It is achievable with the right habits. Whether you are just starting out or looking to refine your financial strategy, these habits can set you on the right track. Once you start implementing them, you will see your financial life to transform for the better. And that was it for today. Thanks for watching, and don't forget to like, subscribe and watch another video. See you in the next one. Thank you. Bye.